Are you learning to invest, or you're investing to learn?
Yeah.
You're doing both all the time.
Because
if you're doing something else, you're missing on an important element.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have big Mike Zlotnik. Mike is the CEO of TF Management Group, LLC. He's a passive real estate investor since 2007 and a full-time fund manager since 2009. He brings over 2 decades of experience in navigating both bull and bear markets. With a background in mathematics, a passion for chess, and a 15-year career in technology, Mike takes a data-driven analytical approach to evaluating investment opportunities, focusing on risk management and return optimization. As a longtime member of top-tier real estate mastermind groups, a frequent speaker at industry events, and the host of the Big Mike Fund podcast that I've been on, Mike is recognized for his insightful real-world perspectives on alternative investing. He's also the author of How to Choose a Smart Real Estate Investment Fund. We're going to have a lot of fun on today's podcast. Listen up. Mike, great to see you again.
Great to see you, Chris, as well.
Yeah, welcome to the show. We're going to be talking about kind of where we are in the real estate cycle today. But Mike, you have a really interesting background. I'd love for you to share a little bit of that with the audience before we dive in today.
Sure. So I'll start this way. A lot of us have seen or have heard James Bond movie From Russia with Love, very old one. So I actually come originally from Moldova. It was part of the former Soviet Union. So I come from Moldova with love, for whatever it's worth.
I love it. I love it. The love is the most important part. I used to watch. While I was taking exams in college, I would watch all the James Bond. They do a James Bond marathon over the holidays. So I've seen all the James Bond movies multiple times, some of my favorites. They got okay for a while, then they came back. I think they're doing a pretty good job now. But man, you could be like one of the main characters, Mike, with your chess capabilities and be a mastermind in there. Maybe at a blackjack table or something like that. You ever gamble? You ever go play cards?
Yeah, for sure.
There you go.
it's funny you're talking about this. As kids, we played chess. I was let's call it, I was a mathematician, a chess player, and the chess players at night, they play cards kind of for many hours. So
there we go.
There's a game equivalent to a bridge. We played just sort of an old version of it. So
yes. Yeah, wonderful. Have you read? You know who Josh Waitzkin is? I'm sure, right?
Yes.
Yeah,
yes.
And, he's written about
searching for Bobby Fischer.
Yep, searching for Bobby Fischer, and then Josh has written about some of the things that he's learned from chess and how he's applied that and different things to businesses and how he's looked at life and learning. I think he's a jiu-jitsu master as well now, if I recall. So yeah, it's fascinating, and I think it's a good point. It's if you can learn how to apply things, then you can apply those lessons throughout life. So I'd love to learn a little bit about what you've learned from chess and how you've applied that to the real estate world, because you guys are involved in a lot of different things. You're very dynamic on your views. So what are some of the big things, Mike, that you've taken from chess, which is amazing? I've had both my boys playing since they were young. And what are some things that you've kind of picked up along the way?
Yeah, funny you said this. Josh is a jiu-jitsu master. I have a 3rd-degree black belt in Taekwondo. And there's something about, I don't know, chess players that one day they wake up and they want to learn martial arts. I don't know how it works, but it works.
Well, what's crazy is my boys, they started playing chess at Taekwondo. They had an after-school program, and their instructor taught them how to play chess, which I thought was amazing. So, you're learning, chess is more like it's a slow version. With martial arts, you have to think a little bit quicker and do that. But the process of learning, I find is very similar. Have you seen the same thing?
Yeah. So we'll talk about chess. Chess is very analytical, very logical. It's a game for learning. Martial arts, yes, you can't think and strike at the same time, like Sun Tzu said. So when you do martial arts, if you're gonna go through chess like thinking for 30 minutes about the next move, people gonna it ain't gonna happen. You're gonna get beaten.
You're gonna be laying on your back, yeah.
But there's some different, thinking physically with your body, learning moves, and remembering through martial arts. But let's go to chess. Yeah. So chess, the way we learn chess And this is I just know I don't know if it's a old Soviet school system or there's something new. I'm sure with the new technology, new evolution, but the learning process is very straightforward. You learn from the great grandmasters, world champions. Very, very important. You basically analyze games of the masters, right? And you do the same in investing. You study Warren Buffett, Charlie Munger, Ray Dalio, Howard Marks, and many others, brilliant minds. Very, very important part of the learning process. So you study their games, you study their moves, you study their conclusions. And then you also study from your own mistakes, right?
Yes,
you
absolutely.
analyze your own games.
Yes.
The learning process has other elements. There's some stuff you learn, openings, a few other things. But in general, study of the best and to study your own moves. There's a famous book by John Maxwell called Sometimes You Win and Sometimes You Learn.
Yeah.
And it's a great book.
Yeah.
So it's very important in investing and in chess to be constantly learning. I literally have this question constantly on my head. And I ask myself a question and I ask the question to the audience. Are you learning to invest or are you investing to learn?
Yeah.
You're doing both all the time.
All the time,
because if you're doing something else, you're missing on an important element. So chess is really all about learning all the time as you're practicing and preparing for the next game. Same thing in investing. You have to analyze your decisions. You mentioned cards and people play poker. What's really fascinating, I'll add this fact. Poker is a game of skill and there's an element of a chance, right? Life is much more like poker than chess because element of circumstances can change and you don't have exactly predictable outcome. You can't compute everything. You have bad run of cards, unfortunately, bad market cycle, bad timing. You can wind up with a good decision, but bad outcome. So in poker, it's all about making the right decision at every point of time. Same thing in chess. But in chess, you can compute everything. In poker, you don't know what the card's going to be next.
Great analogy.
These are important lessons for investing, preparing for possible outcomes, being diversified, being smart about each investment strategy, risks, and what are the possible outcomes. Not living by predictions of a crystal ball, but by living by preparation to different outcomes. That's a better way to think about investing.
I love that. Yeah, and that's a great analogy because the real estate market, the investing markets, are constantly shifting and changing, and doing that. So I think that's terrific. And I think you brought up another good point, Mike, which is an investor has to go into any investment decision and look at their hands, so to speak, and say, am I comfortable with the risk I'm going to take, knowing that the outcome might not be certain in that example. So let's talk about some of those uncertainties in the market. Donald Rumsfeld once famously said, you have your known unknowns, you have your known knowns, and then you have your unknown unknowns. And I found that in investing, it's those unknown risks that tend to get you, that tend to bite you. We've seen the interest rate market rise faster than we've ever seen in history. We had Helene hit Asheville, North Carolina, 1,000-year storm. No one thought that a hurricane would hit Asheville and cause the flooding that we did. And we had something kind of similar, this 100-year storm in the interest rate market that, investors, our age, our genre have never really seen before. So where do you see the market today, Mike, in the real estate space? Let's talk about interest rates and kind of, what are you seeing out there?
Yeah, great comment or quote by Donald Rumsfeld, and I have a different quote for you. I'll because it conveys the same point. Howard Marks, he talks about risk. He says, risk. What is risk? Risk is basically a possibility of a loss in short. But the most fascinating thing about risk, it's difficult to really understand or estimate before the investment and even after. This is the crazy part. You can make an investment. It can produce good results or bad results. If you judge your investment decision by the results, you'll be doing pretty poorly in the long term. Sometimes you make the right decision, but a hurricane, 100-year rare storm hits, and suddenly the outcome is bad, and you might have made a decision, and vice versa.
Yeah.
So that's the best way to think about this problem is you're trying to be a decision maker within your own buy box.
Yes.
And I talk about buy box and don't buy box. And a lot of investors don't think about it. So what is your buy box and what's your don't buy box? And every investor should really get crystal clear on their own goals.
Yes.
What is their risk tolerance? What's their time horizon? What's their liquidity needs? What's their tax efficiency or tax benefits? And there are many other factors. And if you think about those things and you build it first, then you can build a buy box. And everything else outside of the buy box is a no-go. And why it's important, eliminating bright and shiny objects, and you have clarity.
That's right.
If you're looking for safety first, like Benjamin Graham, you're looking to invest. An investment is an operation in which provides safety of principal and an adequate rate of return. Now, you're not shooting for the stars, you're not looking for home runs, but you're looking to hit singles and doubles. And your strategy is much more defensive in nature than you look at a credit fund, or you look at a low leverage conservative income deal where there's a higher predictability of income through credit quality tenants or long-term leases or a number of other characteristics where your volatility or variance is lower while your outcome is much more predictable. However, if you are much more comfortable with a little bit more risk and you could see bigger upside, maybe you go into ground up development, right? It's a risk tolerance.
Yes.
I just give you one comment. I've been contacted by some really great projects in their ground up today. And then the moment they talk about 35% IRR, 40% IRR, these numbers, we're getting phenomenal deal, I tell them that's not my cup of tea. Thank you, but spare yourself time. So knowing what you want and what you don't want is just as important. Back to saying no 100 times and saying yes once for that one deal that really fits.
Mike, that's such a great piece of advice. And I think that can apply. That's one of the things we talk about in our coaching group is, what is your buy box? And if it's not your buy box, just let it go. You could take a look at it. Maybe you learn something from it looking at the prospectus, but you want to say no as quickly as possible. If you're, when I was a hiring manager, I have 100 interviews or 100 resumes. How many can I say no to and get them off my desk as quickly as possible? If you're dating, it's like, hey, this person isn't a good fit for me. I'm not even gonna spend my time and do that. You can do things. It can apply to so many different areas of life. I know one of the reasons I wanted to have you on the show, Mike, is because you are in several different asset classes. So you have a really great perspective across different things. Share with the audience what asset classes you've invested in the real estate space.
Yeah, thank you, Chris. So we have a broad range of strategies, and I'll tell you what we do today. And in the past, we've made some adjustments. So we do like private credit. We do some private lending. We do primary debt. We do mezzanine debt, and lending typically could be on commercial deals or residential deals, right? But we don't like ground up, as I said, on either side of the strategy. Yeah. We do like the family today, especially when the values have corrected meaningfully off the peak. If you can buy well below reconstruction cost at a actually pretty positive spread between the cap rate on acquisition and the cost of money, no matter how difficult it is, if you can find a deal that fits that, you are in really strong position.
So pause right there. Just dive into that a little bit for the audience. So you said, a positive spread between cap rate and interest rate. So dive into that just a little bit. So
the technical term for this is called equity spread. Yeah. So equity spread is a delta between the cap rate that you're buying it at and the interest rate you're paying. So example, we bought was a large 1,046 doors in Q1 of 25, multifamily. We bought it at a cap and financed it with a 7% interest rate. It's beautiful. 200 basis or 2% positive spread, right? So with that type of spread, you are locked into a strong cash flow from day one. Why? Yes. Because the math works this way, right?
And even if you have basically no leverage on that, you're still going to have a 2% positive spread. So
that's what definition of a cap rate means. It
absolutely.
means if you have no debt, you're getting 9% cash on cash without any debt leverage. That's what cap rate means.
Yep.
You had leverage 50%, you get a little bit of enhancement to cash flow. You had 70%, a little more. Yeah. So from that perspective, that's a great way to create a margin of safety, and cash flow is having a strong positive equity spread, cap rate to interest rate. So that's we look at it in everything today. Other strategies we're looking at today, we just closed literally open air shopping, buying a property in San Diego, downtown San Diego, literally at the seaport, 9.25 cap rate, open air shopping, and financing it at 6.5 cap rate.
Fantastic.
So that is 2.75% positive spread, right? It's a phenomenal, strong, downside protected fixed rate debt for 10 years. You're very downside protected. Yes, you have some prepayment penalty, but it burns off year after year. Yeah. So if you hold it for 5 years, your whole penalty burns off. If the interest rates come down, you have optionality. You can either sell in a better environment or you can finance while you're downside protected through fixed interest rate. So we like open air shopping, very contrarian play. It's been very little new supply and still really good growth. And the fear of Amazon effect and e-commerce destroying that asset class completely worked the other way. There's been no new supply, and e-tailers had to open up physical stores. Take Warby Parker glasses. They open up 600 stores where they started as pure internet play. So we like that strategy, very contrarian. Why we like it? Because the cap rates are high. You can get those spreads. Industrial. So we love triple net industrial, absolute triple net, where you can buy 8 to 9% cap rate and purchase finance with debt. Let's call it 6.25. You can get 200 basis point spread. You could have 25-year lease with a great long-term tenant. And you have rent escalation clauses 2 to 3% a year. And you basically have no property management issues of any kind. Everything is on a tenant. Insurance goes up, taxes go up, roof goes. They have to fix the parking lot, anything. Defense, they're responsible. So it's just an example of a strategy we like. And we do some other niche plays, but I'm going to stop a minute at least, turn it back to you.
No, it's fantastic. And I think San Diego market I'm quite familiar with. I spent a lot of time out there with the companies to work with.
So I'll give you the name. It's called Headquarters at Seaport.
Okay, well, I know where Seaport is. I've stayed there multiple times at the Marriott right there. So yeah, I know.
So there's Marriott, there's Hyatt, there's 2 towers of Hyatt next to the convention center, right? And it's literally across the street from Hyatt. It's a historic building. The building looks like old Spanish style with a big, beautiful open courtyard. And you have a Seaport Village that goes around it, kind of a little spread. And then the headquarters of Seaport is that older historic building structure with the courtyard. So it's a beautiful.
It's beautiful. I've done a 5K there on the waterfront. Yeah, I know where
the biggest problem is this. You're gonna appreciate this joke. So I'm at a property meeting up with a partner who's driving from LA, and there's a traffic. California has traffic.
Yeah. Oh yeah.
He's running late, and he says, "Mike, I'm so sorry, I'm running late, and I'm so sorry about the weather." I said, "What are you talking about? You got a perfect weather here. It's 70 degrees. I'll hang out, just enjoy the weather."
Yeah. Yeah, San Diego, 70, 75, 72. No, it's phenomenal. So I like how you're dynamic. You guys are constantly evaluating where the market is in different spaces with respect to that. Let's talk about Fed policy as we're recording this. There's some controversy right now with President Trump firing one of the Fed governors, and that's going through. So there's been, Fed raised rates a lot to counteract some of the money printing that was done, over the past several years. Now let's look at the crystal ball. I know we joked about the crystal ball being smashed on the floor, but if you had a crystal ball, Mike, where do you see the interest rate environment today? Where do you see rates going in relation to the economy?
Sure. So, crystal ball broke, can't find another one for sale. You know the drill. Speculative in nature, it feels to me, again, this is all touchy-feely, that even though the tariffs are still taking time to sink into the system, and it feels like we may have a little bit of volatility, it'll settle down one way or the other. In general, tariffs expected to have one-time impact on inflation, although importers might need time to sink in their price increases. But it's a one-time exercise on a long-term basis. So inflation in general is, in my view, is expected to be cooling gradually over time. Also, AI boom. What is
Yeah.
AI? Massive technology revolution, productivity gains. Productivity is deflationary in nature in general. So I
Yes.
expect a number of forces in the economy to be anti-inflationary in nature. And that should take overall inflation down to a lower level. And that would be significant reason for the Fed to cut and for the long-term interest rates to come down too. This is my theory. I may be completely wrong. We
Sure.
still have the issue of the deficit, right? The deficit as a percentage of GDP, 6-7%, it's too high. However, tariffs are bringing new revenue. We may see significant acceleration in productivity and growth driven by AI, right? We don't know. That's unknown. But in general, maybe some GDP growth, maybe lower inflation, maybe a combination of those things, maybe tariffs. Overall, trade, no, the trade deficit and the budget deficit may come down. So my view on inflation, cooling overall, economy, consumer is stretched. I don't know how else to put it. Number of people have talked about it. 60% of the consumers are stretched. There's probably top 10% doing really well. The other 30% are doing okay. And overall, recent news from Walmart, recent news from McDonald's, they are talking about giving consumers more discounts to make sure people can actually
Yeah.
buy.
Yeah.
So the inflation and the long duration rates, they're supposed to be joined at the hip. 10-year treasury yield supposed to be a reflection of overall long-term inflation. So
which is why Trump says, hey, the rate should be lower, effectively.
Yes. So now we're going to go back with the president of the United States versus the Fed chair, who is more powerful.
Yeah, this is
Right.
fun.
So,
yeah.
President Trump is obviously a very strong arm president. And I mean this, some people think it's great, some people think it's not great. I think in some ways it is, he's a decisive president. He's pushing things forward. So he's accomplished a lot of things. Not everything is perfect, but at least he's doing a lot of things. So in general, monetary policy is independent from the government, from the politics. However, Jay Powell's term is coming to an end, and he's been a hawk for too long. It's pretty clear that he's going to start cutting. How much and how fast? He'll probably go slower than the Trump would like. But give it next 12
Trump won
months.
0, right?
Yeah, I mean, we're talking about, yes, depending on the point of view, they could cut rates by, 150, 200 basis points. Kind of, it wouldn't surprise me over the next 18 months. So we might start a little slower, might go a little faster, but short-term rates are going only way down. There's no other way. Plus, if unemployment picks up, we may see some 50 basis points cuts, not just quarters. So it's not going to be the way they raised at some 75 because they had to quickly get to a higher level to fight inflation. On the cutting front, it's almost like this. Years ago, I watched it. They used to cut fast and raise slow.
Yeah.
They did exactly the opposite this time, and I would expect they're gonna cut gradually, look in the rearview mirror, continue probably with the process. If consumer breaks a little bit harder, they probably going to step into the emergency room medicine. I have a good friend who actually knows Jay Powell, and she's been on TV. She's very vocal. She's a commentator.
Yeah.
And you know what she said? She said this: Jay Powell is not preventive medicine. He's an emergency room medicine. He's not
Good
trying.
Analogy. Sure.
Yeah, he's just If the data starts looking like he's asleep, he's going to wake up and cut a little faster. That's my view. But one way or the other, he's going to cut. And then the next Fed chair probably going to cut more because Trump will put whoever he's going to put a very dovish chair next.
Yeah, and that's some of the things that Trump has said. He wants to see real estate. The real estate markets loosen up. He also we've got a lot of short-term government debt on the books that needs to be turned over. That paper needs to be turned, and it's very expensive for the government. We're about $1 trillion a year in interest at this point, right?
Exactly. Ray Dalio, right? We talked about this quite a bit. Ray Dalio has talked about, multiple ways to get the budget under control. Some of it is, increase taxes, some of it is cut spending. And the third one, the biggest by far, is to get interest rates down. If you get interest rates lower, the impact is much more profound on overall deficit.
Yeah.
So yes, real estate is suffocating and badly needs rates. Some of the technology, not the Magnificent Seven, some of the startups and technology companies that very much depend on level of interest rates are suffering. Private equity, there's some suffering there too. Yeah. And Trump is a real estate guy. So we're talking about huge need for the interest rates to come down from, political point of view, as well as from the U.S. overall fiscal policy, right? We need the lower level of interest rates to roll debt, corporate debt. It would be, what's the word for it? It's much overdue, really needed, and I think it'll be a significant tailwind for real estate. That's the bottom line.
Yeah, I think I was going to ask you that. How do you think that affects the real estate market? Because we have, 100% depreciation coming back, which is a benefit for investors that want to come in, and they can basically depreciate sometimes nearly the entire cost of the property on the front end, which can help offset, income or gains from other properties. And then if interest rates come down, do you think we're going to see cap rates start to I know we've seen slight cap rate compression here over the past quarter, Mike. Do you think that'll follow interest rates as well? What's your take on that?
Yeah, I think that the previous action is after Trump took office, it's just forward expectation, right? Forward expectation, first 100 days in office, expecting him a good pro-business, pro-real estate president. And then now the one big beautiful bill passed and 100% bonus has been made permanent. It's basically confirmation of what we expected. So I definitely think that passing increases tax benefits for the new investments 2.5x, right? 40% bonus on the expiring schedule, now going back to 100 and becoming permanent. It's a very significant tailwind. Two,
yes,
interest rates themselves, right? If we see a little bit more cuts, maybe 10-year adjusts, mortgage rates come down, we're going to see a lot of help, just psychological, directional move may be enough to stimulate demand. And the recovery itself, going through cycles in the past, look at 2008 cycle, right? We had a fast crash and a slow recovery, right? Yeah. So we had essentially a fast crash, if you think about this. Yeah. Higher for longer, fast and furious hikes. We saw a relatively fast crash, and the recovery might take a while to materialize. However, directionally, we're at a point where on many KPIs or metrics, commercial real estate is very attractive, yes, right? From all the benefits, tax, you can get cash. Again, if you buy right, I'm not talking about paying 5 cap and financing at 575 cap and self-storage and then hoping the rate's going to go up. I'm talking about buying deep from a motivated seller situations and then writing it forward.
Absolutely.
So to me, it feels like great time to diversify out of Mag 7, maybe some crypto, maybe some other appreciated assets where people have done remarkably well, and they should take some chips off the table and then put them into what's undervalued, back to Warren Buffett. And think about this. Chess learning from Warren Buffett. One of his most fundamental wisdoms is be greedy when others are fearful and be fearful when others are greedy. Greed is high in Mag 7, stock market, Bitcoin, crypto. And I have no idea where those things go. AI revolution might keep pushing them further. Bitcoin may go to the moon, right? I have nothing negative to say other than the risks have increased based simply on the fact that the prices are higher, and they are no longer looking a lot less at the actual income projections, especially in investments. It's all about the race, US versus yes, China. So valuations approaching stratosphere, risks are increasing. Yeah. It's only prudent to consider diversification. We're dealing in commercial real estate. The deals we're looking at, there are no guarantees in life, right? But yeah, probabilistically, based on likely or possible outcomes, the risk-reward profile has created what is known as asymmetric risk-adjusted return profile in some of these deals. That's the wisdom.
Absolutely. And you brought up a great point, diversifying. 2022, investors were not seeing great returns in the stock market and the bond market. They piled into real estate. Today, people are staying in the stock market, but we're seeing valuations at or near all-time highs with projected future returns over the next 5, 8, 10 years of zero or potentially even negative based on price to earnings and those sorts of things. So I agree. It's a great time to rebalance your portfolio and look at things. Mike, if our listeners want to learn more about what you and your company does with your Tempo family of funds and syndications, what's the best way for them to get in touch with you?
We're going to get really cheesy now. People call me Big Mike. Look, my background, Big Mike Fund podcast, right? I run the podcast with the cheesy
Love it.
name.
I've been on it. Yeah.
Yeah, you're a great guest. I'm really grateful for you to come on that podcast. So it's very simple. BigMikeFund.com, right? It's easy to remember. And if you miss it, if you just go and you forget the D at the end, BigMikeFund.com. I promise it's not a kinky site.
It's not, but I'll tell you, when we hang out, it is big fun with Mike to be had. So, yeah, Mike, you're a lot of fun. You've been a lot of fun to have as a guest, and love having this conversation. Talk about what you're seeing with your chess brain and my engineering brain. Try to figure out what the markets are going to do, and maybe we get together. We can piece together our crystal balls and try to glue them back together. But until that time, thank you so much for being on the Next Level Income Show.
Thank you, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.